Good afternoon, everyone. My name is Stephen Berard with the investments team at Foundation for the Carolinas, filling in for Natalie Wolf today. It's great to be with you all, and thanks for joining our quarterly webinar. I'm joined by our consultants, Mercer, Travis Pruitt, and Tim Westridge, and we have some great content prepared for you guys today. So, Travis, I'll pass it over to you, and you can kick us off.
Great. Thanks, Stephen. Welcome, everyone. Welcome back to those of you who joined us before, and newly welcome if this is your first time joining us. So we will go through a number of things today. If I click here, will work. We'll start with a market overview, a brief market overview, and we'll give you a sense of sort of the quarter as well as some first half dynamics, as well as a couple other interesting notions or developments in the markets this year that are different perhaps from the last couple of years. Big topic on the scene today is the recent legislation passed through Congress and signed by the president. So that will have some impacts. We wanted to just give you a picture of that, a sense of how that might impact markets and in some ways how that might impact organizations like yours or donor plans, if you have plans for gifting or different types of gifting over the course of the year. And then, of course, as always, we'll give you an update on the standard pool performance. Absolute returns have been really pretty good. The market's recovered quite nicely off of an April bottom, and we'll talk about that in total. And then, of course, as always, we'll take any questions. Love to hear from the group. So with that in mind, let's touch on the market overview. And as I mentioned, it was a really pretty good quarter. Global equities were up a little better than 11%. That was largely driven there was a good amount of participation across marketplace. U.S. equities in total were up about 11%. You can see small cap a little bit light of that. Small caps underperformed more in the downturn in early April, but did recover quite nicely, and we'll show you a picture of that in just a minute. But as has been the case for much of the last 5 years, leadership returned, if you will, to U.S. growth-oriented names. And that was true up and down the cap scale. We saw that not just in bigger growth-oriented companies, but also in smaller cap, more speculative type growth companies. And so we did see this rotation in earnest in the second quarter, but on and off for the last year or so, where where lower quality in the sense of companies that maybe didn't have consistent earnings or had negative earnings, or companies maybe that had a lot of debt relative to others in their industry. Those kinds of stocks have benefited nicely from expectations that have gone along with the introduction of the most recent administration. This administration is seen as being pro-growth. There have been while some of the expectations around pro-growth activities have taken second fiddle to tariff, there is still a fair amount of expectation in the marketplace that the administration can deliver on things like regulation reform that can hopefully that with the expectation that kind of reform would be able to drive economic growth. So you're seeing investors lean into that even in the face of some other uncertainty, which we will talk about. Non-U.S. stocks continue to have a really pretty strong run, posting returns again slightly better than the U.S. equities or S&P 500 return for the quarter. So a fair amount of that has been currency, and we'll show you a picture of that. Developed market returns on a local currency basis are about what they've been in the U.S., and we have certainly seen some positive view on potential earnings growth due to certain choices made around places like in the continent. So Germany, for example, recently adjusted the way they think about their debt and spending limits, and that's expected to uncork some additional potential spending that could help the overall German economy. So some of those things, as the President of the United States has pressed for sharing in the armament and protection of the world, that has provided some positive stimulus at different points in time for the quarter. We did see rates in general come down a bit in the first quarter, albeit on the long end, they went up just a bit. So you can see investment grade bonds in the U.S. up about 1% for the quarter. You can see long treasuries down a little. So that's an interesting that implies or demonstrates a steepening of the yield curve with longer dated treasury yields actually going up, whereas the belly of the curve came down a bit. But you can see as we look down here at some of these other types of fixed income, you can see that in a strong equity market, things like high yields and emerging market debt also continue to perform really pretty well. On a 1 year basis, just to give a sense, I know some of you have a fiscal year to date of June, so we thought this would be helpful to see. Global equities, again, really pretty strong return over the last 12 months, up better than 16%. Developed international has been the stronger place there, and again, as we'll see in a minute, there's been a fair amount of currency advantage in the near term to holding that non-US debt, or excuse me, non-US equity, and that gives us diversification in an environment that adjusts to near-term stimulus. And then it's been a while since we've seen bonds generate, a strong single-digit return, but over the last year, you can see that the 1 year core investment-grade bond universe in the U.S. up about 6%, and again, those bonds with higher risk have done just a little bit better. So it has been a pretty tremendous backdrop for returns, an environment that's been laden with no shortage of uncertainty. And so we can see some of that as we get into this next page. And what you're looking at here is half of a chart. So I'll unveil the second half in a minute, but the pink shaded area is the VIX, or the implied volatility of equities, or in more straightforward terms, this is the market's voting mechanism, if you will, in terms of risk. And so the lower this shaded area is, the less risk the market tends to believe. But you can see at points in time, as we see right here, VIX spikes when uncertainty goes up, or risks are seen to be going higher in the marketplace. And we've seen a couple of spikes in VIX, but really nothing like the early April spike when the tariff announcements were made, and they were much, much greater than anticipated. And so that did bring a pretty meaningful drawdown across different asset classes. So this darkish green line is non-US stocks. You can see that they had led the way in the first quarter, took it on the chin a little bit. S&P 500 is the pink line. You can see it traded down. Russell 2000 also trading down. So US stocks started to react in some part to the noise about tariffs prior to the actual April 2nd announcement. But then after April 2nd, you can see that all markets tended to jump off pretty quickly while volatility spiked. There's a lot of uncertainty. The level of tariffs were much greater than anticipated, and investors reacted negatively to that. But fortunately, the administration pivoted, and they reversed or put on hiatus some of those planned policies, and you can see that pretty much across the board, equity securities recovered really pretty nicely. Non-US led the way out of that. You can see here at this top line, S&P 500 in the middle, and small cap stocks recovering. So this has been really the story of the first 12 months of this year. It's a fair amount of uncertainty that's caused some volatility. More recently, that volatility has been positive, as investors in some ways are looking across either I think the term I used in a note to Stephen this morning was chasm of uncertainty, to look for maybe the potential for growth after these things are all settled. And I think we will know a whole lot more after Friday, the August 1st expiration of the extension of the tariff rates. And then we'll get, perhaps get some settlement there, and people can start to figure out just what do we do next. On that tariff score, as we're, we and others are estimating, we expect to settle in somewhere around this 15% level. I think that number might even be up in the last week. This chart's about 2 weeks old. The average level of tariffs at about 15%. This is coming off a base where the average level of tariffs were somewhere around 2. So that probably can and should be expected to cause at least a step function increase in price at some level. If you listen anecdotally to news reports around the world, you will hear that some industries are taking some of that tariff hit to earnings, and only passing along a portion of those increases. That won't be without consequence, right? Because if you're reducing earnings, that will reduce your forecast growth, and perhaps that will filter its way through stock prices. So I think that's something for us to keep an eye on. I don't think we know yet what the full impact of a step function change in prices will be, but it will certainly have some impact at these levels. Really, something we have not seen since the 1930s. At the same time, inflation is moderating, but it's not yet to the Fed's long-term target. So you can see the dark blue line here is the full CPI, Consumer Price Index, which includes food and energy. The core CPI excludes food and energy. And you can see directionally that both are coming back down, but they're both sort of in that mid 2.5% range. The Fed's preferred measure also is above target. The PCE is above target, but the trend is down. And this is part of the reason why you hear the noise and pressure from the administration on the Fed to cut rates. But the Fed is taking a data-first approach to make sure they appreciate and understand the potential impact of the tariffs, both on the potential price level, right, and future growth in the price level in the form of inflation, but also to understand and be prepared to react to any potential negative hits to employment levels. Employment has been relatively stable. We've shown, that shows various signs of strengths and weakness over time, but generally speaking, the consensus view is that labor is in pretty good shape. But that is something the Fed, with their dual mandate, they watch that closely. Market is still pricing in a reasonable expectation of 2 cuts this year. We'll have to see just how that comes together. But this trend is heartening. If we can see this trend continue, then the likelihood of the Fed cutting rates potentially increases as we go through the point of the year. So I talked a bit about this contribution to dollar weakness. And so what you're looking at here, the blue line is called the Dixie. It's the US dollar index, and it's measured against a trade-weighted basket of foreign currencies, things like the euro, the yen, etc. And it goes back. I was able to run the chart back to 2005. And I think one of the keys here on this is as it's going up and to the right, that means the dollar, all things being equal, has gained value against gained strength against other foreign currencies. So particularly since the bottoming of the global financial crisis, which is sorry, I have to look at my other screen, is right here. You can see the trend is by and large been up and to the right. So the dollar has appreciated in value in general against a basket of foreign currencies over the last, call it 12, 15 years. Excuse me. But not in a straight line. You can see that diversification benefit from having U.S. and non-U.S. currencies, that is to say, not actively hedging the portfolio. There are moments in time when there's value in having a diversification. This is one of those times. And so we can see for the calendar year to date basis, non-U.S. returns are about 1,100 basis points or 11 percentage points higher for the year to date basis for the unhedged exposure to non-U.S. Than they would be in local terms. And that is contributing meaningfully to some of the earlier data points we talked about in terms of just outperformance by non-US. You can see by the technical term of waggle in this line that forecasting currency returns is hard, and so we don't actively do that. The notion of whether this weakness will continue of the dollar versus other currencies is very difficult to say. There's been some short-term recovery in that here more recently. But the more uncertainty that the U.S. brings to the table from administration or policy could put additional pressure on the dollar and perhaps work against the direction of the tariffs. But certainly, I think this chart reinforces that while the dollar has been a good place to be over the last decade, maintaining diversification of the portfolio, investing with a global-oriented eye makes a lot of sense and continues to make a lot of sense in the total portfolio construction for the foundation's portfolios. So that's the market recap. I will shift gears here and we'll talk about recent legislation and some of the impacts here. So the signature legislation, I will apologize in advance. Some of these slides are rather boring, so I'll try and punch them up a little and ask Tim to weigh in where he can. But signature legislation was completed in Washington, and we think there are both positive and negative potential impacts. Again, I think these are still potential impacts, so I think we have to see in the face of tariffs, in the face of reactions from other entities and countries around the world. Well, we'll have to see how that all rolls together. But we think there are some things that jump out as potentially positive and negative. Maybe I'll start with the positives. So if you've had a chance to spend any time with the legislation, and I think most of us probably have to take it in sound bites because the length of the document itself is pretty long. But in general, the tax cuts and other stimulative features of the bill itself, or I guess of the signed act now of itself, are that they're pretty much front loaded. So the tax cuts and those features are front loaded. That's to mean over the next year or two, many of the stimulative impacts will go into effect. The spending cuts, the notions that go to paying for the bill, given the structure of our laws in general, are very much backloaded. And in fact, those will come online or be expected to come online around election years. And so those are largely expected to be rewritten. So that is that's an interesting notion that will actually have some feedback on the negative things. But the act also delivers on some of the fulfillment of campaign promises. So no taxes on overtime nor on tips. As I recall, and Tim, maybe you can agree or disagree, I think those are limited in scope in terms of time horizon. That is, they expire or they phase out. Those are not permanent cuts, but they are short-term stimulus or shorter-term stimulus that should, all things being equal, be a positive on overall economic activity, particularly because in those cases, more so on tips perhaps, but even on overtime, those tend to hit folks that are more likely to spend that money than to save it. And at the margin, that would be a positive. And then I mentioned some of this earlier. There are some friendlier business positionings, including investment accounting treatments that may lead to greater amounts of business investment. All positives in terms of economic growth in general. And then again, I think on the horizon that's not yet been passed through is this notion of just further deregulation or enhancement or reform within regulation across a number of industries that could also unlock economic activity. So there are some positives here for economic growth, and by extension, at some point, probably market growth, some of which has been priced into the marketplace already, and maybe some of which is not yet. When we think about what could negatively impact marketplace, these will be meaningful for some portion of the administration's base, and certainly meaningful in terms of some of the data that we see across the marketplace. So spending cuts through changes to Medicaid, it's probably a bipartisan argument that Medicaid needed some reform and evaluation. That has happened in this bill. And as a result, changes to Medicaid through spending cuts are coming. Considering the growth in healthcare employment over the last several years, this could ultimately have secondary effects on the employment situation nationally and broadly, just because healthcare employment has been, under some measures, has rivaled that of government as one of the top places for employment growth. Makes a lot of sense because as a society we are aging, and so a lot of older people needing more healthcare and more healthcare options certainly is a theme or a trend that we shouldn't expect to go away for some time. But certainly cutting some of the spending through Medicaid could have some negative impacts on the overall economy. Similarly, changes to the SNAP food benefits. Which, if you're not familiar, SNAP is the current name of the food stamps program, providing food support to lower income families. The bill moves the SNAP benefit cost from the federal budget to the states, and I think that will be interesting to watch. State budgets are already strained, and in I think virtually all cases, state budgets can't run a deficit. They legally can't run a deficit, so that could have other secondary impacts on local spending across states like North Carolina and others that have to absorb into their budget the SNAP food program. So I think that is something to watch and think about as we think about the impacts at the margin in terms of overall growth. And then elimination of the tax credits for clean energy and electric vehicle investments, basically undoing big portions of the Inflation Reduction Act from a few years ago. That already has put the kibosh on some development projects in some places in terms of economic growth. And so economic growth, perhaps that some states were expecting, won't come to pass. And that will have some impacts, but, again, on that state budget, as well as perhaps more specifically, perhaps other types of spending will step in and take the place of that. But that certainly will be a notion on the negative column. And then, as I noted in the early preamble on this, some of the spending cuts are temporary, and the back-ended cuts, some of these back-ended cuts will likely be readdressed, come election time, as the political environment will certainly drive the way people think about this. We have a picture of this just to give you a sense. There's a lot going on here about this. These are some of the contributors, pro and con, to economic growth. So our view is that in general, the near-term impacts in near-term GDP will probably be modest and positive based on some of those front-loaded features. And we do believe there are upside risks to growth. So we're seeing some of that priced into stocks today. Again, some of the more speculative stocks are performing very well, or some of the stocks with the highest expected growth rates are performing very well, because there is this notion that we're between this act and future activity from the administration, that we could see a really positive business environment. So while there is a fair amount of uncertainty, one of the notions to be mindful of is the fact that you could see a melt up, for lack of a better word, in equity markets. And it is part of the reason, that kind of risk is part of the reason why we don't tend to take big swings away from our long-term targets. We want our strategic allocation to do the work for us, and we want our managers to make the short-term decisions around securities and opportunities in the marketplace. So we are, in all portfolios, we're within a percentage point or two of our targets for our primary public asset classes in general, with some specific differences in some places. But by and large, we're close to our benchmarks, and we intend to stay there so we can be in this place should we get exposed to this upside risk. As I noted, we do start to see in 2028 some cuts, some of these backloaded cuts, and you can see by the slope of our line here on the page that all in over the next, call it 10 years, this package we think would reduce economic growth by a modest amount over the entirety of it, with some slower economic growth down here in the sort of 29 through 34 period. Given the political environment, seems likely that some of that will be rewritten so that we're not walking into potentially structural downturn in economic growth. Or if these programs work and reforms work, then we could certainly, again, surprise the upside in terms of economic growth, and hopefully that also translates into strong earnings growth for the companies in which we invest. One thing we haven't talked about yet in terms of the legislation is projected to increase the deficit and continue deficit spending over the life of this bill, and something to the tune of adding about 3.1 trillion to the federal debt load by the end of it over the time of this 10-year period. This is a picture of percentage of debt to GDP. This is put out by the Congressional Budget Office. This is actually prior to introducing the impact of the tax legislation into this. So this slope is going to get steeper over the course of the next few years, and higher debt then results in increasing allocations of the budget to pay debt service payments. And you hear that quite a bit today in terms of how much. It's a big reason why the administration continues to lever on the Fed, because given the rate, the Fed sets rates, the U.S. is paying, they're paying out a tremendous, with the debt load that we have already, the U.S. is paying out a tremendous amount of interest payments year in and year out. What is sometimes not caught in the notion of this, though, is that deficit spending is stimulative. We certainly, with a 6 or 7% debt to GDP, 6 or 7% deficit of GDP annually for the last few years, that has definitely added growth and income to the U.S. economy, just given that a higher level of spending. That's expected to come down. I think the current administration would like to target 3%, or is targeting 3%, but nonetheless, deficit spending is stimulative within U.S. borders, and between that and the amount of interest payment being paid out, those are relative positives to the overall economic environment. When does that break? At some point, bond investors say we need a much bigger yield to take this kind of risk. That's been a mantra for some time. It is sort of like the last grain of sand argument. You just don't know when that sand pile might topple, but at some point it won't. I don't know if it will before the end of my career, but it is something just to keep on the horizon. So there are some components that hit the nonprofit community. These are primarily impactful to higher education, but one of the reasons we wanted to include this is we certainly know that some of you as individual donors might have gifting plans on the horizon, and so we thought it might be just helpful for you to understand how these changes might impact organizations that you give to, or that organizations maybe that provide services in your community. And certainly you have a couple of meaningful ones there in Charlotte. So let's talk through just those real quick. So the excise tax, so the revised endowment excise tax is really going to impact only those schools with the largest endowments. These are based on endowment per student. And, so for the most part, while there is an increase in the excise tax that goes along with endowments, it's really the primary impact is the very largest schools, the Yales, Harvards, Stanfords, and the like that have just upwards of $2 million per student in their endowment. But we are seeing some, those of you invested in the diversified long-term growth portfolio are likely asking questions of yourselves, or maybe of Stephen and Natalie of the team. What's the impact of the secondary sales that you've seen, say, Harvard make or Yale make in this current environment on our portfolios? And while it is true that organizations like Yale have not historically done secondary sales, they are in a position where they do need to create liquidity. We still very much like private equity as an asset class. We think it makes a lot of sense for long-term oriented portfolios, but in the current environment, payouts have slowed down, realizations have slowed down. And so when you couple that with some of the administration pressures on a school like Harvard, they need to create liquidity out of their portfolio. Those endowments tend to be 50% or greater in private capital. So just as a reference point, the target allocation in your diversified long-term growth is 25%, right? And we're just slightly, around those targets in general. So it's a different kettle of fish. Harvard's endowment funds a great big chunk of their annual operating as it is, and now an even greater amount is needed. So they are doing some liquidity. We think that liquidity, by and large, it seems to be orderly as far as we can see it. Certainly secondary sales are not new in this environment, and in your portfolios, you own some secondary positions. That is, you've bought previously committed positions from other investors. Oftentimes you can get those at least some kind of modest discount or get access to names that you would otherwise not have. So that impact in those larger endowments does have some trickle down, but so far nothing major that we can see. But certainly an area that we will keep an eye on. The bill expanded the scope of excess compensation tax. So this is basically your highly compensated employees pulling down greater than $1 million a year. Again, I think the primary impact on this is for the large organizations where they may not have the ability to attract and retain, investment talent. That investment talent may elect to stay on the commercial side of the business and work for large organizations where they can pull down better compensation. I think that will matter. That could matter over the long term if that pulls down compensation packages or reduces opportunities for folks, maybe changes the way business gets done in the future. That's probably a longer tail. There are some minor adjustments to policies around charitable contributions, primarily in the form of deductions. Under previous law, you were unable to deduct if you weren't itemizing, but now smaller donors do have the opportunity to deduct uh, uh, small donations, even in the context of not itemizing. So that may be helpful for uh, some of you, or maybe amongst other organizations that you work with, you may be able to that may have some positive influence. And then finally, there are pretty meaningful changes to the federal student loan grant and the Pell Grant programs, uh, imposing restrictions on the level of aid per year and over a lifetime. So the perhaps reform that had been out there for a while, so it was addressed in this package. Also involves or introduces some greater accountability for receipt of that aid. But that will, the knock-on effects of that is it will likely change the financial need and situation for both students and organizations as they adjust to this reality of how much of money is available for students to go to school. So I think that uh, selection of items and the impact of nonprofit community, I think it's important, for those of you that give or receive in terms of charitable contributions. These are, this is an area that potentially certainly came under heightened scrutiny as you've experienced through the most of the first part of this year, and so we just want to give you a picture of that. All right. So in the home stretch, we'll run through the standard pool performance. As I mentioned, absolute returns for the quarter really pretty solid. It is hard to argue when our diversified portfolio strategies are up anywhere from 5 to almost 9% for a 3-month period. So it's very super excited about that. So fixed income returns were solid, as I mentioned. Yields came down, so you can see that in here. The income and growth returns are which is 60% fixed income, still up 5%. The longer term, I mentioned during the April sell-off, global equity markets had recovered really pretty nicely. You saw the chart on that. We talked a fair amount about this notion of market leadership being in the lower quality strategies. That did work against us on a relative basis. You can see in the returns, active long-term growth did underperform its benchmark by a bit, and a little bit behind our passive long-term growth, which has the very similar long-term equity structure between them. A little better performance out of the ESG long-term growth portfolio. We've mentioned in the past, the more highly ESG sensitive strategies tend to have more of a bias to those growth-oriented sectors. And as we mentioned, those sectors performed very well so far this year, and so you can see that in the numbers. And then, given just the stronger diversification away from the public markets, not surprising to see diversified long-term growth not have the same level of absolute performance, but participating nicely, and again, held back a bit by the same notions of active underperformance in the short term. We've seen that across our book and across the industry. As the market evolves, we're seeing already in July some evolution in terms of market leadership. And so we hope to continue to see that through the rest of the calendar year, but in an environment of hopefully mostly positive results. So with that, I will pause and see if there's any questions.
Thanks, Travis. If anyone has any questions on the call, you can put them in the chat, and we're happy to read them out. But maybe I can kick us off here, Travis. It's interesting. I feel like a lot happened in the second quarter. Seems like it was, 12 months of activity with the huge drop in the beginning of April and the big recovery. Reminded me a lot of 2020 when you saw kind of what happened in March. We didn't have obviously a global pandemic this time around, but you just had a lot of fear, those down 4 to 5% days, multiple in a row, and then sharp V-shaped recovery. I just looked up the S&P ended 2020 up 18%. We're about halfway there here. What would it take kind of in the back half to, get to those type of returns in 2025? You kind of mentioned some positives and negatives. Kind of how are you kind of weighing those? I'll ask you to get your crystal ball out.
Sure. Here, and I'm going to stop sharing so it can just be our real faces instead of our cameo faces. So I think a couple of things. I don't know if we can get to 18, right? We're about halfway there. So I won't speak to a particular level, but what could lead to further gains from here? Uh, First, in my opinion, I think the first item at hand is getting past the tariff noise. So it has certainly been true, albeit the market has become less and less reactive to it, that the oft changed expectations for tariff levels by country has been disruptive. But as we've seen increasingly, if you will, since maybe the second week of May, is investors have largely looked across that chasm and said, well, it's just going to be noise. So we're going to ignore it and try and focus on what we think is coming next.
The taco
And
trade,
the
Travis.
I wasn't going to raise that, but uh, definitely investors have said there's going to be a lot of this is negotiation and this is how it works with this administration. So let's just assume it's going to be something, and then let's run our numbers and see if it makes sense after that something comes to pass. And if we've been too ebullient in our view of where that tariff level might be, then we'll have to adjust our prices and maybe we'll get some rebound. But we need to price past this. And I think you're seeing a fair amount of that in the last couple of months. Friday, if the no extension comment holds, then we will know a whole lot more on Friday and through the weekend and on the Monday what those tariff levels will look like. And then, you know, business people, investors can make decisions once they have information. Uh, Absent, good concrete view as to where exactly we might be going, it's just hard to make those business decisions. And, there will likely be some noise. And frankly, realistically, the level of those tariffs may come in differently than's priced in, and maybe we go up or maybe we go down because there is some sort of expectation about what's priced into the marketplaces where tariff levels will be. And so the buy, the old saw, buy the rumor, sell the story or sell the news, could come to roost here in the next couple of weeks, just depending on which way the market might have erred in terms of pricing those in. So I think removing that uncertainty, even if it leads to a short-term downturn, ultimately getting that uncertainty out of the way will hopefully then set the stage for, okay, what do we need for the next stage of growth to go, and how will businesses position, and how will they be able to seek earnings growth that will drive hopefully stock prices along with it through the end of the year. Uh, once tariffs are settled, I think the expectation is that there will be much more attention paid to the reform of regulation, which is expected to unleash new waves of growth. If there's positive vibes on that through the fall, you could certainly see that investors starting to price something in there. So maybe something more than maybe is priced in currently. Any news on the interest rate or inflation front will matter a lot in terms of driving returns. If the yield curve steepens, that won't necessarily be a good thing because businesses invest really longer term in Ocean, and certainly risk assets are priced with longer term risk-free rates like the 10-year Treasury, and the 10-year has been caught in a range for the last couple of months between, call it, 430 and 445. Every day I look at it, I'm a little bit caught off guard because it seems to move 10 basis points, every few days, but in a pretty tight range. So that kind of trading environment may just provide the kind of stability if it maintains, just to continue to tick higher through the course of the year. But I do think that we have to always keep our mind open to uncertainties or other things that might uncork if something goes. We have this revised deadline for Russia to respond to demands in regards to the Ukraine war. That certainly could go poorly, and that would be those kinds of geopolitical events usually are risk-off situations. There's just a handful of those things that are hanging out there that remain to be resolved. So, the economy seems to be in okay shape. Not blazing, but I did see GDP growth came out at 3%. I haven't had a chance to read that article yet, so I'm interested to see where the growth comes from. I imagine there are some that are a little skeptical that it's quite that strong, but those are the kinds of things that hopefully can keep markets on path. And maybe if uncertainty does creep in, but the economy continues to grow in the right kind of way, maybe we see a broadening away from those more speculative names, and we get a little bit better participation really in the U.S. Outside the U.S., our non-U.S. and emerging markets exposures are generating really nice premiums versus their benchmarks. We don't have the same, there's not the same kinds of challenges there have been in the U.S. marketplace. I should mention that, talk a little bit about those weaknesses, but we're getting great implementation, and most of the other tools that we're using. It's this U.S. equity is a very tough place to compete.
That makes sense. Yeah, it seems like if tariffs are kind of off the table, we'll hear from Jerome Powell at 2:30. We'll have a Fed decision. Obviously, no rate cut expected today, but if we can get rate cuts, tax cuts, some stimulation from this new bill, I mean, those are all positives. And that if tariffs can kind of be settled, so it'll be interesting to see what happens in the back half of the year, and we'll talk about it in our next quarterly call. So. Thank you, everyone, for joining, and thanks, Travis and Tim, and we'll see you all in a few months.
Sounds good. Thank
Great.
you.
Yeah.
Thank you. Talk
Talk
soon.
soon.
Take care.